Everyone, thank you for joining us for day two, Smallcap Discoveries Investors Conference. We talk a lot about the discovery process. It's actually part of our name, and we feel it's extremely important for investors to really understand what we mean by the discovery process. So what we thought we'd do today is actually bring up examples, almost live examples of companies that are going through the different phases of the discovery process. But before we do that, I'm going to explain what we mean by this, and then we're going to get into some interesting discussion with the companies here. Okay, so what is price discovery? The process of moving from an unknown and mispriced company to fair value to potentially overvalued. Obviously, as an investor, we want to find companies before everybody else finds them. That's where we feel the biggest price movement or price discovery happens. Of course, why does it matter? Discovery drives returns, and in many cases, drives returns greater than actually the fundamentals of the company can justify. Many microcaps trade at deep discounts to larger private peers for this very reason. They're not well known. And then we also believe the greatest margin of safety exists when you find these type of companies early in their discovery process or life cycle. I'm going to almost read verbatim off here, but price discovery, there is a life cycle. Pre-discovery, what we call retail discovery, institutional discovery, and then post-discovery. I think we've all seen examples of this, but sometimes we may not just quite identify them. Understanding each of these stages can really have a massive impact on the performance of a portfolio. And we notice that microcaps offer a structural advantage when it comes to discovery. Small companies, or rather institutional funds or institutional capital, have a very hard time purchasing small and microcap companies, and that's the advantage that retail investors have. Okay, so let's get a little bit more into the three stages of discovery. Obscurity. I think we may even own some companies that we feel are obscure and nobody really understands. These are companies that have typically very little coverage, if any at all. Low liquidity because nobody's aware of these companies, so they're not typically traded. And they almost trade as if they were private companies. What typically happens is we call it the discovery process or the discovery time, or even the discovery event. Something happens to trigger attention. It can be a combination of things. It could be a specific news release. It could be a newsletter mentioning the company. It can be a set of financials that spark the market. It could be analyst coverage. It could be a number of things. But there's usually an event that triggers that discovery. And it's where investors take notice. And then the stage three or the discovered portion of it, where companies are now actually trading and are significantly well known and are trading much closer to fair value because they're much more understood. Okay, so discovery itself, not just the fundamentals, can be the key driver outsized returns. So as I said, we believe that investors who pay attention to this process will see outsized returns. You want the combination of strong fundamentals and an undiscovered stock to give you that extra margin of safety as well as that extra increase in share price. So early discovery typically means weak valuation, obviously low share price, limited investor base, minimal or no media coverage, weak liquidity. This is usually where you see a frustrated management team that are complaining about share price, complaining about liquidity, difficulty in doing any kind of M&A because they don't have the share price currency, and usually if they're looking for financing are at the mercy of the market when it comes to raising money. And at these points, a lot of times you'll see management teams will be talking about taking the company private or selling it to try to extract value. Mid-stage discovery, the market cap and share price is rising. It's usually led by sophisticated investors, many of you which are here today. These mid-stage discovery companies as well, very limited institutional ownership. We actually seek out companies that have either no or very limited institutional ownership because of this process. Again, little or no analyst coverage. I know companies want to have analyst coverage, but as investors, we want to be there before analysts start to cover these type of companies. At mid-stage, you start to see cost of capital is improved. Companies are more likely to start doing financings because they can justify, issuing equity. And shares may be seen as cheap or fairly priced still by management at this point. Of course, then later stage discovery, what we look for is broad awareness. Retail and institutional investors now are engaged. At this point, you're starting to see companies getting mentioned on BNN. You're starting to see more investors talking about these type of companies. You may go onto a bulletin board or investor bulletin board, and you're going to see more chatter about these type of companies. As far as the companies themselves, at this point, it's easier to communicate. There's a larger audience already. That audience sort of repeats the message, and IR or investor communication, obviously, at this point, gets a lot easier. As far as the benefits of the company at this point, cost of capital is significantly lower. Equity financings come easier, and with a higher share price comes attractive M&A opportunities. This is a point where management finally get an opportunity to leverage their higher share price. So why is this important to investors and why is it important for public companies? As I said, this type of understanding, if you can find a company that is less discovered or undiscovered, your opportunity for outsized gains increases dramatically. Discovery drives returns. We really want to emphasize that. Liquidity improves, and that also attracts investors. So as a company gets further discovered and that liquidity improves, those that were hesitant to buy because of the lack of liquidity start to approach the company. And asymmetry of opportunity. Undiscovered companies carry less downside risk and upside potential. It's interesting how many times we talk to investors and they will shy away from companies that are illiquid or seem to be perpetually undervalued. It's the sophisticated investor that's brave enough to buy these type of companies that tends to see those outsized returns. And those that understand the discovery process can position themselves ahead of broader recognition. That's what we try to do at Smallcap Discoveries, is try to position ourselves ahead of the institutional capital that eventually has to almost come into these type of companies. Now, why is it important for public companies to understand this? Higher share price really drives the cost of capital, right? And it's important to know where you are in that process to understand where your cost of capital could be in the right sort of conditions. It enables more efficient capital raises. Obviously, a higher share price helps, but also more awareness helps. So if a company is significantly more understood and aware, better known in the industry, financings happen faster. There's more competition for those financings. We have examples of this up here on stage here. The share price is not always tied to the fundamentals, right? So this is not simply a function of fundamentals have to get better. There's a lot of things companies can do to improve market awareness. And some of these things are not that costly, but there are things that companies have to understand and the tools that are available. The catch-up effect. A single re-rating can compress years of progress into one sharp share price move. I think we've all seen that. Companies that are obscure for years, all of a sudden there's a transaction or there's an event, and there's rapid price change, and that is a function of that discovery. The market suddenly recognizes value that was always there. We see that very often. A company just struggles to get noticed. keeps building value, and then almost overnight, price changes. I would suggest that many of the companies that are successful, that are even presenting today, they'll tell you that they struggled for 5 or 10 years, and then all of a sudden it feels like they became an overnight success. It's all a function of discovery. Broader capital market benefits, greater visibility in the investor community, and easier IR communications. More attractive stock options help with employee recruitment and retention, and higher profile increases awareness of products and services. So it's not just things that affect the share price, there's other benefits by getting properly discovered. Okay, so I wanted to show two quick examples, and then we'll get into some discussions here. But Foran Technologies, here's a company that presented at our conference, I believe the first time 3 years ago. And you can see what's happened to the share price here. This is a company that's been profitable for a long time, so you can argue the fundamentals had been there for a lot longer than before the company or the share price started to accelerate. You can see 2021, 22, and 23, I would argue it almost flatlined for those 3 years. But then we start to see a pickup in share price. And not just an increase in share price, but an increase in the rate of growth in the share price. And that is all a function of that discovery process. You go from sophisticated retail investors, institutional investors, and eventually more sophisticated and larger institutional investors. Now, this is a company that over the course of, 4 years, has seen a tremendous rise in share price, over and above just the growth in the fundamentals. So why is the PE ratio, for example, why has that increased over that time? And we would argue it's just a function of more and more people getting to know the business. And of course, another example, it's one of our favorites, Zedcor, who we have up here today. We started speaking to the guys at Zedcor easily 3-4 years ago, and started to notice something that was changing within the business. But it continued to flatline, or the rate of growth in share price was pretty muted over the first 3 years of that chart there. But then something really happened in early 2024. And we could probably go back and pinpoint a few different things, but look at the change in the rate of growth in the share price. I would argue that in 2023, late 2023, there was probably very, very little institutional ownership there. And the sophisticated investors were the first to move into a company like this. And you can see what happens when the company gets properly discovered. Now we're seeing much easier funding for the company. Institutions that are all talking about owning the company. Company's been mentioned on BNN a number of times. This is a perfect example of discovery. But I can imagine, in talking to the boys here, that they probably were pretty frustrated in the first few years of that process, trying to get the company noticed. All right, and then just we'll call them some old discovered companies. You can look at XPEL and Bioscience. These are two companies that we were very early shareholders on years ago. These companies have gone up. In the case of XPEL, it's gone up over 100x from where we first discovered it. Back in the day, it was trading at less than 8 times earnings. It had put together over 20 quarters of profitability and growth, and it was trading at a single-digit PE ratio. Today, it trades at about $30 and about a 40 PE ratio. And it's growing significantly slower than it was back then. But the discovery has happened. Almost everybody in the Canadian microcap space has heard of XPEL. Bioscience, more or less the same story. Two more recent discovered companies, I would argue, is Kits Eye Care, who presented at our conference several years ago, and VitalHub, same thing, another company that presented several years ago. Both those companies are up significantly from when they were first discovered. And then two that we would argue are going through the discovery process right now, Hydrite Technologies, NURS, and Zoom Technologies, both companies that we recognized early and are now up over 10x in the last year and a half. All right. Okay, so with that, I'm going to turn it over to the team up here. I'd like to have everybody maybe give a quick 60-second elevator pitch of your company, who you guys are, and then we're going to get into some Q&A. So we'll start with, why don't we start here with Owen and Beware.
I'm Owen. Nice to meet everybody. And thanks, Paul. Thanks for having us on. Beware is a IoT company. We design and manufacture asset tracking devices. We focus on distributing our product through large partners, including the likes of Bell, Bell Mobility, AT&T, T-Mobile, as well as a number of technology partners. We've managed to secure a large number of Fortune 500 clients, and we're excited about the prospects of growing within those clients over the next coming year or two.
My name is Jason Bailey. I'm the CEO and co-founder of Eastside Games. We're a mobile game application developer. We have a whole bunch of different games, mostly IP-driven, so making games for the big famous Hollywood IPs, The Office, Trailer Park Boys, Doctor Who, Star Trek, etc. And we're very much in the process Paul's talking about of being discovered. You pretty much described our company exactly as that undiscovered company. And we're happy to be here today and meet all you guys, talk to you guys. We'll be at table 7 all day. Come by and say hi.
Todd Zeniak, President and CEO of Zedcor. We're a mobile security tower company, as most people in the room know. Paul's right. I rolled my company in here 10 years ago. Feels like it was 30 years ago to get where we are today. It was some pretty tough sledding, but we've expanded our company across Canada and now moving into the U.S., and it's going quite well. And we have our product's 100% customer agnostic. Makes it pretty easy, for your customer base to be that large. And this is Amin. I'll let him introduce himself as well.
Thanks, Todd. I'm Amin Lada, the CFO. It's kind of interesting seeing some of those charts and kind of looking back at the history and looking back at the events, like Paul said, that kind of spiked the share price, and I'm sure we'll get into some of those, so it's great. Thanks for having us.
We have Stephen Huey here from Pembroke Asset Management. We're gonna sort of pepper these guys with questions, and maybe Steve, just give a couple seconds intro as well.
Sure. So I'm on the institutional side of things. You're ahead of me. You've heard of a lot of these companies before I have, and we're the ones who are showing up and driving some of these share price moves. My comment is, well, you might think it's late in the game in discovery. From an institutional perspective, it's still very early. So lateness and earliness of discovery is all in the eye of the beholder.
Yeah, no, and that's sort of the thing. I'm the retail guy, he's the institutional guy. I'm trying to get to it before he can. But when guys like Steve come along and find these companies, we know that we've done our job. And he's right. Time frame is a big important piece. Retail investors tend to think shorter term. Institutional capital has to think much longer term. So they look at these things differently. But understanding what somebody like Stephen is looking for in advance, especially fundamentally, as an investor, that's the advantage we have. So if we can find one of these companies that have all the right fundamental ingredients, and yet may have just too low of liquidity or the market cap's too low for their participation, we just have to buy it and wait for it to get there. And then guys like Steve are there to buy these companies. So we thought what we'd do now is we'd ask all the different companies some questions. Now, the reason they're up here and we chose these companies is we believe they're going through or they've gone through different stages, right? So Zedcor, from a retail standpoint, is much more discovered than Eastside Gaming's. And so Eastside Gaming's would be something we would argue is undiscovered right now and think has that opportunity for retail discovery. Beware, we believe, is in the process of discovery, right? So it is now being looked at by institutional capital. And of course, Zedcor now is being looked at by much more sophisticated and larger institutional capital. So we thought we'd pepper them with a bunch of different questions and see how they respond. So Steve, take over.
Thanks, everyone. I guess we can just ask this to all the companies. Where do you think you are in the discovery cycle? Let's start with Owen.
I think we're kind of accurately portrayed and just on the verge of potentially being discovered. Like a lot of companies, we grounded out for 6 years. I think our share price was statistically impossible to stay at the same level for that many years. And you know, as a result, we just focused on the business. You know, we felt the best that we could do for our shareholders was to sell the product, run a profitable company, and you know, not worry too much about the capital markets at that time. We have zero budget for IR. And I actually said that to a gentleman from the TSX, and he almost hung up the phone on me. But it was the right thing to do at the stage that we were at. So I think we're kind of, you know, early, mid-stage, and we're excited about the potential.
We're very much undiscovered. Nobody knows who we are. I'm sitting here in the room all by myself, all lonely.
I own your stock.
Yeah, you got some.
I
You
own
got
it.
some. I know there's people in the room that
got
own
it.
some too. You know, thanks to Paul and Trevor and the work they did. I know they've brought some shareholders to us, but we have no major institutional holdings. We're lost in obscurity. I think you guys got a tiny bit, but not enough to move the stock price just yet. But I'm reeling them in. So it's exactly as we described. We know nobody really knows who we are. I'm very much focused on the business and the fundamentals of the business. You know, we're trading at less than half times revenue. We'll do 80 odd million last 12 months, and our market cap's 35 million. We're profitable. We have a great foundation of games, but yeah, when it comes to the public market stuff, I don't really know. This is not my world. And so when we went public in 2021, which was the peak of the market, you know, no regrets there. But here we are now, and of course I was given all the promises. Don't worry, buddy, we're going to take care of all the public market stuff for you. You're going to be fine. You run the business. Well, yeah, it wasn't Paul. Wasn't Paul, but here I am, you know, I've been kind of orphaned by the banks, and because all they want is the fees, and I'm not about to raise money at this level or do anything at this level, so, you know, I'm kind of ignored. And so, you know, we've done a lot to bring the business fundamentals together, and now I feel like we're finally ready to come out and start talking at conferences like this and talking to investors and telling that story and hopefully get discovered.
I guess, well, I wouldn't have ever thought we'd say we've been discovered, but I think we're kind of at that point. You know, I think the biggest thing that's changed for Zedcor, when Amin and I first started going to Toronto, we didn't even know what we were doing, and you know, nobody would listen to you. You couldn't get the time of day. Seemed like you're saying the same people over and over. But we're to the point now in a company that we're graduating into different investors. You know, and we're breaking different thresholds. The $500 million market cap's a big one, opens doors for different funds that can start buying us. But, you know, as far as saying discovered, I think we're pretty undiscovered as far as the U.S. investors go, and some of the bigger Canadian ones as well, because they just can't look at you until you hit different thresholds. And it's opened the doors for us quite a bit, but I would say, you know, I think in the U.S. side, we're quite undiscovered, but there's a long runway ahead of us. I don't know if you want to add something, Amin, to that.
Yeah, I'll just quickly add, I think Stephen said it well yesterday and this morning, is that in the retail space, we might be discovered and you might have missed the 50 cents to $5 or the 10 cents to $5. But we're just scratching the surface at a company level, and the U.S. expansion, the opportunity in the U.S. is massive. So wouldn't want to promise any future gains, but just be cautious on the retail side too, that the U.S. guys look at it differently and the retail guys look at it differently, or the institutional guys look at it differently. So it's just timing, like Steven said, and you might have missed the gigantic, but there's still opportunity, I think, in our stock as well.
Yeah, and I want to make it clear, when I talk about discovery in the realms of small cap discoveries, we're really talking retail discovery and Canadian retail discovery. So it's an important point that the guy said here, discovery continues, right? We call it institutional discovery in Canada, but that's still small cap institutional discovery. The U.S. is, you know, when they look at a $500 million market cap company, they rarely call that a small cap, right? That's still a micro cap. So there's a tremendous amount of ongoing discovery that's possible, and by no means am I, you know, suggesting that Zedcor, you know, is done in that process. But it's important to bring that up. So you guys, you're right. There's ongoing levels, but as far as the sort of the unknown Canadian retail investor type of discovery, that process is still early stage.
Maybe a question starting with Zedcor then. You have managed to engineer an escape velocity from microcap indifference. What advice would you give to others who are looking to get that escape velocity?
I think the biggest thing is for us, something I always said is let's just focus on the business. You know what, when you're where you guys are at and you're trying to grind it out and get attention, sometimes everybody gets caught up on the stock price too much, but something that Means heard me say 100 times, numbers don't lie. You know, bury your head in the sand, build the business, everything will follow. You'll get recognized, and that's exactly what we did, right? To be able to get through that time. And I don't know, I mean, if you want to add to that, but I think
You
it's,
summed it up perfectly. Like, stay the course.
Yeah.
Hit the numbers. Don't overpromise, and kind of just hit the numbers and stay the course. Go to Toronto every now and then, meet with people, and do what you got to do. Like, just focus on the business, I think, is the key.
We used to have a saying, don't call us, we'll call you, right? From sophisticated investors, you don't have to go and find them, they'll find you, right? So if you're doing the right things, which you guys clearly are, and I would say all three of these teams are doing the right things, don't go out and try to over-promote when it's just not time, right? We will discover you guys. And you guys did exactly that. You just put your head down, you worked hard, and then the ball started. And what typically happens is sophisticated investors are the catalyst for that. Call it IR, right? We go out and we tell other people. And when that starts, it's the interest is incoming, right? And you guys saw it. You're a great example. So I know from time to time there's companies that are frustrated that it's not happening, but it happens. It just, you have to wait for that magical moment, and it's hard to predict exactly when that's.
My door's open. I'm standing there.
Hey, listen, we're watching and waiting. You bet. So, well, sort of same question. Maybe, guys, what do you think? I know there's frustration to some degree at different levels, maybe less so for you now, Owen, but are you doing anything different? And are you feeling that frustration? Yeah, let's chat a bit about that.
Yeah, I'm feeling that frustration. The promise with being public was that you have access to capital. You can raise money easily. The mechanisms are in place to do that. You can use your magic internet money to do M&A. But when you're trading at the levels that we're trading at, I can't do any of those things. So it doesn't seem reasonable to be public. And I keep questioning myself, well, like, why aren't we public? Should we go private? Should we? We're having conversations, but I don't know why I'm there, and it costs us $1 million a year to be public, and I'm not getting $1 million worth of value out of it. That being said, here we are, so make the best of it, and I've been doing exactly that, is like just head down, focus on the business, numbers don't lie, put the numbers out, and we're profitable, we've got great revenue, and hopefully, you build it and they will come. But at the same time, you need some sort of catalyst. You need that story to be able to tell. So, we're building that catalyst and feel like we're finally at the point where we're ready to come out and start having these conversations and telling these stories. The challenge is knowing who are the right people to talk to and who are worth your time and who are a complete waste of time. And, we know Paul and Trevor, very much worth your time, incredible community that you've built and do a lot for the community. But then, I'm sure everybody in this room can name a handful of people where the opposite's true. And, it's fast money in, out. They're looking, they want to know if your stock's going to double next month so they can get in and get out. And that's just not the game that we're here to play. We're looking, long-term and building a real business.
Owen.
Yeah, listen, it can wear on you when your stock stays at what the company thinks is a depressed level for a long period of time. It certainly takes its toll. And you can actually start believing in the conspiracy theories. It's like, it's not me, it's naked shorts, or it's algos, right? They're holding my stock down. And the reality is it had nothing to do with naked shorts or algos. It's just there's more buying than or more selling than buying at a particular level. But it comes back to focus, right? It comes back to just, if you're a public company in technology space, you got to grow. And you got to grow profitably. That's the thesis that we've taken, and eventually it'll come around. And we're starting to, as it starts to come around, what you start to worry about going forward is, if I get discovered, how do I prevent myself from being undiscovered? Like, what are the guys doing that, like when you look like a Kraken or even bigger companies like a Constellation Software, right? 25 years, 30 years of continued discovery and growth. And so you almost have to look the next stage forward to figure out what your next challenge is going to be. The last thing you want is this big roller coaster ride, right? You really got to stay focused.
Go for it. Well, what I was also going to say is that over time, you end up getting the shareholders you deserve, right?
Yeah.
And depending on how you went public or if you do a heavy IR promotion or things like that, you get a shareholder base that tends to be different than what you might deserve as a public company. We've seen a lot of companies that go public with a bunch of fanfare, and there's a lot of excitement, a lot of money around IR. But if the fundamentals don't justify it, sooner or later, that shareholder base has to start to change, right? They get bored, or they get interest in some other shiny object, and you have to now work to get the right kind of shareholder. So we see that that sort of thing happen over and over again. I think from companies, especially those that are looking at going public, we think it's extremely important that you really understand that process and have expectations that are really tethered to your fundamentals, as opposed to what unfortunately promoters or some others that come out and promise and aren't quite the fact. So that's important to say that.
You touched on this at Eastside Games in terms of the lament that you don't have the cost of capital to go play offense. Let's say a bunch of institutions showed up tomorrow and gave you a cost of capital, cheap cost of equity. How would you guys play offense? I guess that's for everyone.
If we suddenly had a bunch of capital tomorrow,
In terms of good multiple.
right. Well, for us, then we'd have that opportunity to really, rocket fuel our growth. We'd be able to go out and get more and bigger IPs, build more games at once. Right now, we're doing 2 to 3 games a year. We could do a lot more and then drive those numbers. Drive the profile, take more swings at the bat, and hopefully knock one over the fence. And at that point, you start to get the interest of those Americans. Because again, it's the same thing, just like you're saying, $500 million in America is small cap. So step one is build ourselves up in Canada, get to that valuation, and then we can look at bigger markets, and that would be the pitch to the institutional holders of help us get there, and $20 million, $25 million in the till would really give us that opportunity to take that big swing without, because being small, you gotta be profitable. You got to grow. You can't get in front of your ski tips. You got to be really, really careful. But with some fuel in the tank, you can take a bigger swing.
For us, in terms of use, we look at the success that Zedcor has had with their business model, right? Very stable, quarter-over-quarter growth. And I don't want to speak, especially with your CFO on the stage, but
by all means.
You're bundling a solution. It creates very predictable growth. And, our business model has been always to sell hardware, make a little bit of money up front on the hardware, and then charge a monthly service for our application. And we've seen some initial success by doing something similar to you in bundling the hardware with the software and investing in your clients, essentially. So I think, we haven't raised money in over 6 years. We've just grown our cash position through generating operating cash. And so at this stage, we've decided to deploy some of that cash over to a different business model. But we're taking it slowly. We have a cap. It actually turned into a great sales tool for us. So we will sell 8,000 units a quarter under a finance model. And really, we made that decision because we didn't want to blow our brains on it. We wanted to make sure we maintained a good, solid cash position. But the effect on the clients were like, oh, well, if they're only going to do 8,000, we better get the orders in early so that we can get our piece of that 8,000 under the finance model. So it turned into an interesting, sometimes it's better to be lucky than smart. And I think that was an example of where we were.
I think for us, as far as capital goes, obviously now, we've got a lot of capital coming our way if we want it. And But I believe in protecting the investor and protecting your float. You just don't take capital to take capital because, when we hear all kinds of things from all of them, oh, the market could change, this could happen. I go back to one thing I always tell him, numbers don't lie. If we keep executing, that's where we are as a business. We have to execute. And something Amin does a great job is keeping control of our analysts that are covering us. They start running numbers. Oh, if you built it this fast, you could be here. Well, you could be here on EBITDA this many quarters. We're building our business like this. We don't want to get it going too crazy like that. And because we're a service business. If you get too out of control, you lose control of your service. And it's great that we're in a position that we do have capital if we need it, but, just to back up the tape, after we rolled our company in here, prior management put us into a forbearance agreement. I had to clean it up. We rolled in 16. I went into a forbearance agreement 3 months after, went from VP of operations to COO, 2019 CEO. This will never get back to a forbearance agreement, I can tell you that. I never put us there. I had to live through it. It's one of the worst things you can ever go through in life. Probably as any company, especially a public company. And, you got to be smart with the capital and the use of capital. Everything we take capital for goes right back into our business. I don't know, Amin, if you have anything to add to that, but I think, we got to be smart when we take the capital. We're not just going to take capital to take capital.
Yeah, I think you kind of hit it nicely. Like, look at all forms of opportunity in terms of capital, and don't just take it just for the sake, or don't just dilute for the sake of diluting.
I got one that's not on the list, but could you share with us a moment where you had news, you had a development, and the market didn't get it? There was absolutely no discovery, and you just scratched your head?
Or anti-discovery.
Everything I've ever done.
Yeah. We had a blowout quarter, grew some 65% year over year, and the stock traded off about 10% on the day. So you can get those types of things, but you work through them.
Yeah. No, I think just my mom and you are the only one watching, I think. Okay.
Well, I'm there. Yeah.
I think, we've had that scenario quite a bit, especially in the beginning. We were an energy service company turning into a security company, and nobody was really buying into the story. We were still just an energy service security company. And then we really had to spread our business across Canada to, almost run from oil and gas to prove that, hey, we're not just an Alberta-based company. And, you'd do press releases then. Like, I think our market cap back then was about 9 million. We'd move maybe 300,000 or 300 shares a day. It was pretty, it was pretty bad, right? And we, the press releases that we were putting out was more survival ones than good news ones, I think. Amin, you'd agree with that?
Yeah, and I think some of the inflection points take some time for the market to digest and people to hear the news, and it's kind of for us to get out and spread the news. Like, Trans Mountain ended in 2023, and that was a big piece of our business, and we saw the numbers kind of coming up, and we just had to get out and spread the message, and people had to believe in the message, and it might take a quarter or two after that to see that, and I can understand where investors are coming from. It's a big change, and they want to see that change kind of reflected in the numbers. And then you saw the share price. I think once the market saw the news and kind of we kept hitting the numbers and running the business, that's when the share price caught up, and now we're where we're at.
I mean, maybe Zedcor here, guys. Do you find that now that you are, I'll say significantly more discovered, do you change the way you communicate with the industry or investors? I imagine there's a lot more phone calls and a lot more inquiries. Does that take a toll on the business in any way?
I think we got to the point, Paul, we got to manage our time, right? Because I'm a very hands-on CEO, and as you keep growing like this, more banks get onto you, more analysts, they want more time, more investors, and we're in a bit of a competitive market as well. We do conference calls now, but we got to be cognizant of what we're saying on them, because anybody can be listening, and I think you got to manage your time. We've actually set up our schedule now that these are the days we take calls. We're doing road shows, and this is the week we're going to do it. And other than that, we go back to building the business, because at the end of the day, if you get too distracted, and you can lose sight of your business. And I think it's key that we stay on track doing what we do. We've got a lot of great investors that have supported us from 8 cents. They're still in it. Now we're graduating to the institutions, to some of the funds and stuff, and they respect that. You know, the institutions get that. And like Jeff Torrey, that's on Steve's, you know, at Pembroke, I've met with him about 4 or 5 times now. And every time I walk out, I think to myself, wow, this guy gives us such great advice on the business. You know, he said, go build your business, keep the guardrails on the growth, and you'll be successful. And, you know, Amin and I sit and listen to guys like Jeff. You know, Jeff does a lot of teaching at the universities and stuff. And you get the opportunity to spend time with guys like that, you got to take it all in.
Any of you guys have any comments in terms of, now you might not be getting as many phone calls as you want, but
Yeah, but they're still there, and so I'm curious. For you guys, how much time do you spend on those kind of one-on-one investor calls? It's always hard to know, like how big of a piece they own and whether they're serious about getting a bigger one and what it looks like. You got to split that focus. I'm very much focused on the business. I'm a very hands-on CEO as well. But how much time would you say you do spend in a month, like just one-on-one calls with investors?
I think the one-on-one calls are pretty rare. It's kind of like who you built the relationship with, who you know. It's kind of after a quarter, a day or two, everybody wants the update. Even though you have a conference call, even though you have an MD&A, they think they're going to learn some more in that. So you just kind of have to manage that accordingly with the guys you know that are in the story and who you built a relationship with. I think
And I think as you get bigger too, the analysts do a lot for you. They've got a lot of investors calling them. Like, we'll talk to our analysts. Amin talks to them all the time. And then they have a lot of investors that are phoning saying, hey, what do you think about Zedcor? And then they're phoning the next analyst. They've got such great relationships with all these analysts. I think that's a fair statement to say that as you get a little bit bigger and those analysts believe in your story, they're actually doing a lot of the communication for you. But, we just started doing the conference calls to eliminate some of the calls. And then we've got, you know who your main guys are that are in there. And obviously we take time because as we grow, we got a whole bunch of different institutions coming as well. So, you can't go silent. It's a balancing act, but
And those main guys will promote your story too, right? That's why I said the relationships are important, where they go and promote you to the next guy or their buddy and at the next fund.
And so those analysts, because my experience with analysts, we had 4 or 5 covering us for a while. Were they were the banks, like the smaller banks that essentially covering us because we raised some money with them, and I felt like my job was to write their reports for them, fill in all the blanks for them and give them the numbers they wanted, and then they turn around and give me some hold, it's like, well, thanks, that's real helpful. Eventually I was like, why am I doing this? Have I got the wrong analyst?
So I'll chime in on this one because I'm a consumer of a lot of analyst reports. Not every brokerage house and not every analyst is equal. Yeah. There are some analysts who balance well their mandate, which is, yes, they need to generate banking and trading revenue for their firm. But I'm also a client, and they need to generate alpha for me. And if all they're doing is schlepping crap onto my desk, well, I'm never going to buy any of their firm's deals or their deals. So the best sell-side analysts who have longevity and credibility, they are also skilled stock pickers. So it is finding that right relationship and the right analyst who can help you as a firm grow and finance your growth, but also help us. They are out there, but you have to find them.
So I should look at your list of analysts and go after those guys.
I think we've had a fairly positive relationship with our analysts, and yes, at some point, the markets will change. I understand that, and I think it's like Steven said, you just kind of have to balance who's good and bad, and understanding who's trying to just generate fees versus who's trying to really promote the story. And I think, yes, to some extent, you are kind of putting the numbers in their models, and if that's what it spits out, then I think you just got to keep your head down and run the business and keep focused. Like, the hold rating is just one opinion from one person, and yeah, it might carry weight, but that's where you just have to kind of know your shareholders and see who's key.
I want to ask one more question to Zedcor specifically. Was there a point in time where you said, finally, it looks like the market has woken up to us? And
Yeah.
what do you think caused that?
It was really when Trans Mountain ended for us, Paul. The end, you can see at the end of 23 and we're getting into 24. The real big point there that happened was they sent all their towers back way earlier than they're supposed to. And thankfully, we opened up all the branches across Canada and we were able to redistribute them to every branch. And our utilization went like this and right back up. And at that point in time, we had some warrants coming off. Hey, I mean, some real key things happened at that time. We were around about 60 cents, 55 cents.
Yeah, like 50 to 70 cents range.
We had warrants that were coming into the money at 70 and we were about to extend them. You know, we were thinking of doing it and all of a sudden the stock hit 71 cents. Our lawyers, Denton's phone said, you can't extend the warrants, they're in the money now. And then after that, it just really, it took off. And, you know, we had a couple good banks behind us that really believed in the stock and a couple key guys that were helping us get in front of people. And I think that was a real inflection point for the business. It was 2024 at the beginning.
Yeah, and it was kind of two, and they sent a bunch back at the end of Q1, and we saw internally and externally too at a later date. But the number spiked in Q2, and then number spiked in Q3. Q2 they spent, or Q4 they sent everything back again. But we knew we could get them out, and it was just like I said earlier, getting the message out and showing the street the numbers and getting everybody up to speed on that.
And I think it's great once you get the momentum going. Because once that happens, every quarter is your report card. That's just reality. And as long as you keep executing and keep beating it, I think how many quarters are we now that it's quite a few that we've beat our numbers and not, you know, I'm not talking by 60%, but, you know, just being able to beat and being able to do what you say you're going to do, it becomes key for guys like them to buy into your story. And yeah, man, I'm where these guys were. Why don't we go private? Like, this is ridiculous. And to be honest, the reason we didn't, we had some long-term people in the actual float, and we thought, man, we can't do this to them. We could have at one point did it, and we stayed the course. And you know, and I had a guy tell me once you get on the other side of this, being public can be pretty fun, and you know, we're seeing that now. But yeah, it's been a long ride to get here for sure.
No, and congratulations on that. So why don't we open it up to questions? If any of you have any questions for the gentleman up here, we'll take them. Jennifer, I see you've got a question. So what Jennifer was saying is that over time, it might look like nobody's paying attention, but sophisticated investors tend to follow a company. And I'm finding this more and more. They tend to follow a company longer than a lot of people realize until they see that inflection point or that key moment. And, you know, they've built confidence, they've built experience, and all of a sudden now they can get very active very quickly because they have that comfort. So you were going to say something, Jason?
No, I was just wondering if there was any insight into how we could see that. You know, how do you know that people, like I get that there's people watching and there's things, and I come to the conferences like this and people say, I own a little bit, I got a little piece, I'm keeping an eye on it. And of course, you know, you don't want to buy at 50 cents and hold it for 2 years and then have it go. You want to buy at 50 cents right before it goes, right? You know, the cost of holding capital. Is there a way to see it? Like, where are you watching it? And is there any way to kind of see and reach that audience that it's watching?
I can answer that because that's what we do. So when you start as a company, if you start seeing a lot more inquiries, if you're getting a lot more phone calls, even if they're general inquiries that tend to happen, guys like us will start to, you know, reach out and ask questions and follow up the next quarter after a set of financials or maybe after a news release. You want to see that increase in inquiries. That's an early indication that people are starting to pay attention. Well, so what Jennifer said is that usually there's somebody influential, or we say sophisticated investors. Sophisticated investors will start to inquire, and once you have them as shareholders, they start to spread their influence. So whether it's somebody like us, I mean, you have a board member that we think is quite influential, and it's things like that. That is a good sign. That is a signal that the right people are starting to pay attention. Yes.
As a segue to your comment about the board, Paul, and the notion of building relationships with investors, I'd be
Yeah, that's a great common question. So he said, how important or what do you do about the board of a public company and their impact on being able to deal with some of these sort of discovery issues? And I would agree. I think it's extremely important to have a board that a capital markets sponsor that we talked about yesterday that has a material investment in the position because they have a vested interest to make sure your company gets discovered. So I think it's extremely vital that public companies address that. I don't know if anybody else.
Part of our process is we look at board composition, board incentives, whether they're engaged, because we're very much interested in that escape velocity being achieved. And if we think that that board is not, if we think that they're just in management's pocket and not fighting for us, then I don't think that escape velocity is going to happen.
Yeah, I'm as investors, watch for those things. Watch for a change in board member that looks like they're addressing some of those issues, whether it's a specific skill set, but more importantly, we look for somebody when we see a capital markets, experienced capital markets player join a board, we know something's starting to happen, right? So look for that as investors. We're running out of time. If there's one more question, I'll take it. Go ahead.
We are aggressively buying back as many shares as we can. The NCIB rules on the TSX are pretty restrictive, so there's a maximum number of shares we can buy every day. We're always buying that maximum number. We're being as aggressive as we can, buying back those shares. And occasionally a block will come up, and if a block comes up, we can buy that block. But I wish the rules weren't so restrictive, or we'd buy back more because it's the best investment we can make is in ourselves. It's ridiculously underpriced. If we can get, we've already taken several million shares off the market, and we'd love to take more.
Listen, we've run out of time, and appreciate everybody. Hopefully everybody here can give a round of applause for the gentleman up here.